Welcome to BondTV. First in private capital news.
Good afternoon and welcome to another episode of BondTV. I'm Leslie Clark. Looking at the global macro, artificial intelligence, AI capex continues to drive public markets. The most curious investors are now looking through the AI spend for signs of revenue and ultimately cash flow, which remains yet to be seen. While AI is clearly strong in pattern recognition and automation, it remains to be seen when those skills will warrant the current FOMO. This past quarter, we saw a growing circularity in AI companies investing and buying from other AI companies. While the pace and volume of AI M&A may feel frothy, much of it is grounded in real business needs. However, if companies start acquiring without clear synergies or overpaying for hype, the bubble risk grows. The current form of circularity often appears as a symptom near the top of a bubble environment. Moreover, the transactional administration in the US has found its heavy-handed strategy to rewrite trade relations with its three biggest trading partners unconstructive to date. The three biggest partners are Canada, China, and Mexico. In total, this group represents 35.5% of imports and 36.8% of exports. With this ongoing uncertainty and confusion, the overall growth outlook remains subdued compared to pre-pandemic norms. The World Bank projects global growth at just 2.3% for 2025, the weakest pace since 2008 outside of recessions. With this backdrop, stores of value have seen growth in asset allocations during the past 12 months. What makes a store of value in 2025? Investors are prioritizing assets with strong cash flow, loans, and dividends, value public equity, low debt and high return on equity, resilience to macro shocks, gold, and reasonable valuations, loans. The last point is likely the most difficult to find right now. During 2025, investors have favored a diverse mix of value stores that includes AI firms with real earnings and energy-exposed public equities, private debt for its yield and downside protection, select real estate, and tangible assets like commodities and cryptocurrencies, as hedges against currency volatility and inflation, plus collectibles at the high end with provenance and scarcity as a traditional inflation hedge and heightened ultra-high net worth demand. Private credit continues to grow as investors seek out safe havens to weather the ongoing upheaval in global supply chains. The agility and resilience of private entrepreneurs who issue private debt continue to outperform other alternatives and, in particular, other sources of income, like real estate and liquid traditional bonds, while providing a hedge against inflation with reliable cash flows. It is no surprise that high net worth, retail, and institutional demand for higher-yielding private credit opportunities corresponded with a decade of sustained low interest rates from 2011 to 2021. Now that this era of compressed yields seems to be behind us, private credit should be looked at as a dynamic portfolio allocation within the context of a broader core portfolio invested in liquid, lower-risk yield solutions. While you can't eat asset appreciation, you can live on yield with capital preservation. During the third quarter of 2025, Canada's private credit sector demonstrated robust growth, paralleling global trends in investor demand for alternative yield sources. Private credit has benefited from floating rates and traditional banks holding an above-average amount of non-performing real estate loans, which have resulted in retrenchment and more cautious underwriting. Overall, private credit returns in Canada exhibited lower volatility than public equities or liquid high-yield debt, offering steady income streams and portfolio diversification. Projections implied continued high single to low double-digit gross returns contingent on mindful due diligence and borrower performance. This landscape underscores private credit's role in providing consistent yield while preserving risk-adjusted stability. Delinquency rates remained stable, indicating dependable repayment capacity in direct private credit lending. The few high-profile exceptions, Tricolor Holdings, a broadly syndicated loan, BSL, to a subprime auto lender and dealer. First Brands, a BSL with factoring to an auto parts supplier, and the Cantor Group, Andrew Stupin, and Gerald Marcy, a direct commercial real estate loan, were bank lending failures. None of these loans is private credit. We believe these defaults are the result of investors reaching for illiquid returns within liquid product structures. Furthermore, the lenders in the real estate should be scolded for not perfecting their security. The BSL performance is a reminder that a ratings agency is not a replacement for due diligence, and possibly something that is beyond investment-grade product should not be purchased in the first place. This isn't to say that private credit is infallible. According to Lincoln International, a multinational investment bank, covenant defaults, technical breaches of loan terms rather than payment failures, have risen from 2.2% in 2024 to 3.5% currently. This manageable result was best illustrated by Lincoln's data, which shows the last 12 months year-over-year EBITDA growth of 6% to 7%. This is the highest level since Q1 2021. If left to their own devices without overt government intervention, entrepreneurs will figure things out. Tim Hines, Global Head of Credit Research at DebtWire, said, "The weakest companies are starting to get hit because of the tariffs and economic slowdown. You're going to see an increase in bankruptcies, but there isn't systemic risk." Meanwhile, BlackRock has doubled down just when Diamond warned of cockroaches, while Mohamed El-Erian said he would be more worried about termites than a few cockroaches. According to TransUnion Canada, senior direct lending continues to deliver steady, risk-adjusted returns for diversified portfolios. The sentiment from the Canadian Family Office's newsletter is the combination of robust origination and disciplined risk monitoring is a key to sustaining growth in private credit markets. About Bond Capital. Bond Capital is an award-winning private credit fund and direct lender serving the North American lower middle market since 2002. We structure senior secured credit solutions that preserve ownership while delivering attractive risk-adjusted returns to investors. Thank you for joining us on another episode of Bond Capital TV. Whether you're an operator, investor, or advisor, staying informed is your best defense in uncertain times. We hope you found today's insights valuable. I'm Leslie Clark, and we look forward to seeing you next time.